In general, I don't like the idea, and it won't be any great surprise, of governments regulating pay. I do think that in general that's something that should be left to the market. I won't discuss tax and other incentives that encourage particularly undesirable forms of pay, and I think most of the option schemes, share option schemes in the corporate sector in general, I've written about that in the past, have been a massive rip-off of the shareholders. But that's a separate question, and I wouldn't want to legislate against that, but that's another matter. However, I regard financial institutions as fundamentally different. Large, complicated, complex financial institutions are fundamentally different from all other businesses. They perform essential and highly subsidized public functions. That's my first point. Second, of course, their liabilities are money. They are guaranteed both by governments through deposit insurance, which is effectively universal and much wider than than it is explicitly, and of course by the institutions of central banks. And their assets are, of course, the economy's lifeblood. For this reason, when banking systems fail, and they fail with extraordinary frequency, there have been well over 100. And don't treat this as a purely US issue. There have been well over 100 major banking crises, effective insolvency of entire banking systems in the world as a whole in the last 30 years, probably now getting on for about 120 or 130 over that period. In the context of crises, their impact on public finances and the economy is remarkably similar to that of a war. Governments always intervene if they have the means. They are themselves solvent to rescue banking systems. There are virtually no exceptions to that rule, even in this citadel of capitalism here in the US. And as Carmen Reinhardt and Ken Rogoff have pointed out, the direct and indirect fiscal costs of a major banking crisis tends to end up by doubling the quantity of public debt, and they also tend to be associated normally with very long recessions, lasting on average in the developed world 5 years. So in this case, we may assume, and I think it's highly plausible, that at the end of this story, US public debt will have risen probably roughly doubled relative to GDP. I think that's very plausible. So these are major public policy events, and the idea that the banking system can be regarded as a branch of the free enterprise system is, in my view, unfortunately, a fantasy. So regulation is inevitable and essential because there is a massive public interest. My own view, this is my fifth point, is that the focus of such regulation, if it is to work at all, has to be about incentive alignment between the various parties to the financial institution within it and the public interest. That means the incentives relating to shareholders, management, that might be top management and employees, with a particular interest in discouraging what is the most inevitable feature of a financial sector which has such guarantees, the guarantees I've described, and they're always there, which is that they are constantly going for broke. And technically, they're constantly taking risks, the upside of which are enjoyed by the parties to the firm, shareholders, management, and staff, and the downside of which are enjoyed, quote unquote, by taxpayers. This is the characteristic of this industry. I'd like to remind you that the money center banks of this country, and I'm just looking at this country, have quite certainly been bust 3 times in the last 30 years, and every time they've been rescued by the state. So the sixth, that means at the general level, it means a requirement that there should be more capital, much more capital in the banking system than there has been, because of course logically institutions which have these explicit and implicit guarantees don't need and they certainly don't want any capital at all, and they're trying to run with about as little as possible because they know where the downside falls. But it also means, I think, reconsidering the charging structure for guarantees, and I do believe that a progressive charging for guarantees to banking systems with particularly high charges for institutions that are deemed quote unquote too big to fail may lead us towards a banking system which we can treat somewhat more as like a normal market banking system instead of these horrendous oligopolies we now have. Of course, you will have noticed that everything that's happening now in the US is moving away from that desirable outcome. Number 7, it means, in addition, looking very carefully at the incentive structure of these institutions, because if those incentive structures are likely to lead to massive losses, they are going to fall on the taxpayer directly and indirectly. And that seems to me what is special about these institutions, and why it is rational for regulators to be concerned about the incentive structures operating throughout the whole firm. My 8th point, what then are the considerations that should be borne in mind? Let me make clear at this stage, this may be different from some of the views of one of the other panelists, I'm not myself directly concerned here with the level of pay. I don't want the government to decide how much people are paid. I'm concerned with the structure of pay as it relates to the incentives for those people who work in the firm, and the extreme importance of minimizing the possibility, you can never eliminate it, that the employees gain the institution at the expense of taxpayers, as we've seen so often. So what are the considerations? First, the time horizon over which performance pay is granted has to be related to the time horizon over which the outcome of decisions can actually be measured. And as I pointed out in that column, it happens to be the case that a year is an astronomical phenomenon. It is not an economic phenomenon. There is no reason whatsoever to suppose that the true consequences of decision making in these institutions will emerge within 1 year. The periods have to be much longer. Secondly, the pay must be related to performance on the risky decisions taken over that relevant time horizon. That is to say, it must go at least to a considerable extent both ways. Of course, we understand there's a limit to this, which is why other regulation is needed. It's very difficult to pay people very large negative sums. And of course, people can leave businesses. Again, none of this can ever be more than highly imperfect. That is the nature of this bargain we've made with this diabolical sector. 9th, for management, I think that means restricted stock released at least, in my view, 10 years after issuance. And for staff, that's number 10, pay paid or subtracted on a base related to long-term outcomes of trade with clawbacks, explicitly part of the contract, related to both group and individual performance. Stock-related pay for most workers is ridiculous because they have no impact whatsoever on the stock price of the companies that they work for, except in very exceptional cases. Citigroup employs about 350,000 people. Not many of these people are directly affecting, unless they're completely hopeless, the pay of the performance of their institution. They certainly don't relate to the stock price. I've always regarded stock incentives as irrelevant for most staff. 11, as I said, this is not about the level, but about the structure of the pay system, and it is where our financial services authority is going to go. And finally, the reason 12 regulators have an absolute right to look at the structure of pay along with other aspects of the complex financial institutions that the government has decided are too big to fail, God damn it, because they represent, and I repeat this, because the regulators represent the interest of the risk bearers of last resort in the financial system, which are and will remain, without question, the taxpayer. Thank you very much.